In this session, let's try to understand the process of securitization in more detail. As we have initially defined, whenever we use the word securitization, it is like a company will have some credit sensitive assets. Credit sensitive assets means there is some amount of uncertainty in terms of receiving them or in terms of getting their full value. So it could be as simple as some current assets like accounts receivables or inventories, which form as a part of my credit sensitive assets, or they could be the long term things like let's say the loans for a bank, housing loans, or probably credit card receivables. If I look at it from a bank standpoint, the credit card receivables. So any of these, they are called as credit sensitive assets. For the simple reason, there is some level of uncertainty in terms of their collection, and there may be some kind of default that can happen on those assets. There may be a reduction in the value on those assets in reality. So those kind of assets I'm trying to sell. A company is trying to sell off those assets to a third party. And this third party will issue, buying those credit sensitive assets, it will issue some securities. It could be in the form of bonds. It will issue the securities to the investor community. So for this investor community, as and when the cash flows come from here, they are transferred by the third party to the investors. So the instruments are created, the securities are created in such a way that the payment to the investors, both in terms of coupon as well as principal or intermediate cash flows and final cash flows, they are paid based on the cash flows that are received from the underlying entity here. So they are backed by the pool of these cash flows. Now, initially this party which has bought these credit sensitive assets, it is pumping in cash here. And the moment it has pumped in cash, here the assets can be removed from the balance sheet. They can be removed only if they are recourse. Only if they are non-recourse. Means once sold off, it's a true sale. So only then they are removed from the balance sheet and it is becoming an off balance sheet kind of a transaction. So whenever we are doing a proper securitization, it becomes an off balance sheet transaction, and we see that many of these assets, so it could be either accounts receivables or inventories, or from a bank standpoint we'll see there are different kinds of loans, but the common feature is still the same. Each asset will have to generate some kind of cash flows in future, right? So in this process, if we are seeing this particular company which wants to sell off its assets, credit sensitive assets, we call it as the originator. And the company which wants to initiate the securitization process. In most of the cases, it could be the same firm which is initiating the securitization process, or it could take the help of some other firm to initiate the securitization process. So that particular firm is called as sponsor. So it could be a parent company of this which is initiating the securitization process. But in a good number of cases, this firm as well as the securitization sponsor will remain more or less one and the same. And this particular party, who is the third party, who is purchasing the asset, credit sensitive assets, and acting as a bridge between the investors and the originator. That third party is given various names. He is either called as asset purchaser or a transferee, or even going with a securitized product issuer. Probably this is looking like a much better name. So this particular party takes the responsibility of purchasing these credit sensitive assets, against them issuing these securities to the investor community. And it's a different legal entity, generally gets organized as special purpose entity, because its main objective is purchase the assets, nothing else. Its main objective is to purchase the assets and then create instruments. So that's the reason these companies get created as special purpose vehicles or special purpose entities. Now, wherever these kind of securities are issued to the regular investors, there is a trustee, right? Every such kind of a bond issue requires the role of a trustee, whose main interest is safeguard the interests of the investors. Whatever has been mentioned as a part of the prospectus, or probably for a bonds we talk about the indenture, whatever are the do's and don'ts that are being mentioned as a part of the indenture, the trustee's responsibility is to make sure that this transaction, or the bonds that are issued, they are adhering, or the SPV is adhering to those kinds of do's and don'ts which are mentioned at the beginning of the contract itself. And of course, any issue will have a custodian, whose major role is to safeguard these physical securities, and along with that even get into the process of distributing the intermediate cash flows like dividends, or in case of bonds the coupons. So that is the role that is performed by the custodian. And this entire process, right, this entire process requires an advisor in terms of how to create these kind of structured products, what kind of products are required. There should be someone who would have researched on what are the different kinds of economic needs of different kinds of investors. So what is the market for each of these structured forms? So there should be some kind of a structuring agent who should really decide on, who should advise this company in terms of what proportion should go into what kind of tranches. So the design of this entire security is done by this structuring agent, and he is the person who might have got into the forecasting of the interest rates, and based on them forecasting the cash flows. So this is the key role in terms of this entire structuring process. And once the various tranches and instruments are created, An underwriter comes in terms of marketing and distributing the issue. Just like any other product, we have an underwriter. We can have a rating agency who will rate the various tranches that are created. Probably the senior tranches getting a very high credit ratings, and the subordinated or mezzanine ones coming the next level credit rating. So we require a credit rating agency to typically rate these various tranches that got created, and there is a need for a law firm who can guide in terms of the legal, accounting, tax kind of aspects. So like this, there are multiple parties that could come in a securitization transaction, but the prime scenario that comes in any securitization transaction is the selling of credit sensitive assets to a third party who will issue securities against those credit sensitive assets and sell them to the public. To a large extent, we see that this particular third party is getting organized as a special purpose entity, and to a large extent, this will be a bankruptcy remote kind of an entity. Very rare chance of defaulting, it becomes a bankruptcy remote kind of an entity. So this is a very brief overview of the securitization process. Now we will see how this securities are actually getting, the securitized products, how are they getting issued? How are they actually getting issued? We'll try to understand that aspect now. Generally, we talk about the two major mechanisms of this issuing. One is the SPE. Here, the major focus is on the SPE that is getting created. What we say is this SPE, which is a third party, can be created either as a corporation, can exist the legal structure by the SPA, it could be a corporation or it could be incorporated as a trust. But in either of them, the originator who wants to sell off their credit sensitive assets, originator will sell the assets to the corporation, or the originator will sell the assets to the trust, because it is selling the assets to the SPE itself. And in some cases, the SPEs are already existing. Let's say for mortgage loans, mortgage loan purchasers and all, we have existing entities like Fannie Mae, Freddie Mac. These are some kind of SPEs which are already existing, which are handling this particular markets. But for let's say for some other assets like your credit card receivables and all, we may not have any SPE. So on that, so for that transaction, an SPE has to get established. And what we are saying is this SPE can get established either as a corporation or as a trust. Generally, when it gets established as a corporation, when the originator is selling the credit sensitive assets, this corporation is paying cash back to the originator and it is issuing the securities. So what could happen is the distance between the originator and the corporation is not that different, is not different from an accounting purposes. So the originator did not distance itself from the corporation for the accounting purposes. Whereas when this SPE gets incorporated as a trust, what we see is in reality there are two SPEs that get created. If it gets incorporated as a trust, there are actually two SPAs that get incorporated, where we talk about one as a master trust and two as a grantor trust. So the selling of the assets from the originator happened to this master trust. This master trust will in turn transfer the assets into the grantor trust, and the grantor trust is getting into the issuing of the securities. So the connection between the originator and the issued securities now is very much distanced off. So typically we talk about so if at all the SPE is getting constituted as a trust, from an accounting standpoint, the distance between the originator and the issued securities is getting widened, and the claims of the securitized products are backed by the beneficial claim on the master trust rather than on the assets themselves. So, the additional, see, in this trust kind of a mechanism, we have created an additional SPE. It is primarily necessary to separate the originator from the issue so that it will be considered as a true sale. The reason being, now, it is not sure whether the sale here is a true sale and it becomes an off-balance sheet transaction or not. But in this case, I can consider it as a true sale because the transaction from the originator happened with the master trust, but the security, so there is two layers that has come up. So probably the connectivity between this and this is almost negligible. So which means they can be removed from the balance sheet quite comfortably, and it is a true sale of the assets, which means it can be treated as an off balance sheet transaction. So that is from that standpoint, if the SPE is being constituted as a trust, it is much more beneficial from an accounting standpoint for the originator compared to SPE being registered as a corporation, right? Now, regarding the same, another important aspect that we need to look out for is the different forms of credit enhancements that might be required with respect to a securitization transaction. Different forms of credit enhancements that may be required with respect to a credit enhancement mechanism. Here I would like to talk more in terms of the internal credit enhancements as well as external credit enhancements which may be required, right? See, the more primary forms of the internal credit enhancements, we talk one about the subordination, means the simpler structure that we are creating, a senior structure, a mezzanine, a subordinate, senior, mezzanine, subordinate, or probably even equity. The various tranches that we are creating, this is the subordination structure. And in this subordination structure, we are seeing that the credit risk is getting fully distributed. Here the risk is much lesser, whereas when it comes here or here, the credit risk is much higher, right? But this alone may not solve the purpose for all kinds of securitized instruments, because we see that the assets that are securitized, there is a lot of variety in them. and especially the needs, the risk tolerance of the different sets of investors, the risk tolerance limits of different sets of investors differ. The credit ratings which are desired for different kinds of tranches, what are the desired credit ratings for the various instruments that are getting issued, all these things need to be considered to probably work out on the better credit enhancement. Though subordination is a mechanism, but on the other side, to achieve a better credit ratings, to achieve to try to address the risks of the risk profiles of the investors heavily, the other form of internal credit enhancement that is typically looked at is the over collateralization, a very important aspect in the securitization process. It's as good as, let's say, the purchased credit sensitive assets are to the worth of X. The securities are issued, the securities are issued probably to the extent of 95% of X or 99% of X, but not the full X. Means all we are talking of is the assets that are pledged to back this particular security issue are more in value compared to the actual issue. This is what we call as over collateralization. So within this 0.95, probably I may say, okay, 0.3x is for senior, 0.4x is for mezzanine, and 0.25x is for the subordinated. So what is happening is any loss that is coming on these purchased assets up to the extent of 5% is directly absorbed through this over collateralization itself. And anything, let's say, between 5 to 30% is absorbed by this subordinated, 30 to 70% is being absorbed by this mezzanine tranche, and anything above 70% only, it's going as the loss for the senior tranche. So having the more collateral, the collateralized assets are more than the issued securities. That is what we are calling as the over collateralization. This is a very strong form of internal credit enhancement, and this will definitely improve the credit rating of the issue. Any kind of an issue with this amount of over collateralization, the credit worthiness or the credit ratings can quite drastically be improved. And now the other mechanism that come into picture is, okay, a direct equity issue. Like, okay, now if the collateralized assets are to the worth of X, what the various forms of debt can be issued only, let's say, to the extent of 80% of X, whereas the remaining 20% can be issued as equity. But the biggest problem is for these kind of structures, the equity portion demand is much lesser. So sometimes what happens is the SPE themselves want to retain the equity portion or some portion of that equity portion. The SPE itself want to retain that equity portion, but that would violate the independence, right? So sometimes another mechanism of internal credit enhancement that is being looked at is a holdback mechanism. a holdback mechanism wherein see, for the purchase of the assets itself, the SPE does not pay full amount, to the originator. It pays a reduced amount, and only after or only towards the end, the final settlement wise, the remaining portion of the amount is being paid. Even that would be like an internal credit enhancement mechanism. Otherwise, this is another important one, which is a cash collateral account. A very easy to understand concept where it says that the originator should maintain a separate account. It maintains a reserve account. The originator should maintain a reserve account, which is like a backup in case the losses come. In case the losses come as a part of the assets which are sold, which means the originator is not fully delinked from this transaction. So it will not become a true sale, because if there are no losses, this reserve can again be transferred back to the originator. But if there are losses, the amount is pulled from this reserves and tried to pay for the losses. So it's still a credit enhancement mechanism, but it will not delink the originator from the issue. That's one more. And so which means it does not become a true sale and it does not become an off balance sheet kind of a transaction. And in some cases, all these various internal enhancement mechanisms are being tried out by the SPE to make sure that the credit ratings and meeting the needs of the various sets of investors is done quite comfortably. Apart from just creating a subordination kind of a structure, it can look at one or more of these mechanisms, but of course over collateralization looks like the most important of these mechanisms as a part of the internal credit enhancement. Now, if I try to look out for an external, right, the various external credit enhancement mechanisms that are there, these are very interesting. It could be done through an insurance contract. Means what could happen is, okay, the senior tranche will be protected here. Means the SPE will take an insurance policy which will protect the senior tranche. Like if at all the losses are coming up for this senior tranche, the insurance policy will make the payment for this senior tranche. For that, a deductible is to the extent of, in this insurance, the deductible is to the extent of the payment to the subordinated tranches. Means if the losses are to the extent of subordinated tranches, the SPEs themselves will transfer the funds from the subordinated tranche payment to the senior tranche. But if the losses exceed that amount, then the insurance policy will come forward to make the payment to the senior tranche, which means the senior tranche is fully protected and in no way even the assets get into whatever kind of losses, there is a protection that is coming up to the senior tranche bondholder. The same logic can work out with respect to credit default swaps. So this can buy a protection against the default in payment to the senior tranche. So only the default in payment to the senior tranche will be protected against by getting into a credit default swap, because most of the performance of the credit default swap is on the same lines as insurance. So either there could be an insurance contract. So by taking on the full portfolio along with the deductible set at a subordinated debt level, which is more on the same lines like an insurance contract, can work very well with a credit default swap also. Then the SPE can take a letter of credit again for the senior tranche itself. So if at all the losses are greater than the subordinated debt, the subordinated debt threshold, whatever it is, we see that the letter of credit will get applicable. The credit line is drawn and made a payment to the senior debt. So the full payment to the senior tranche again happens even through this kind of a mechanism. Or there could be a put option taken on the underlying assets. So with this put option, again it would be set to a predetermined price, and generally the predetermined price is nothing but the loss level of the subordinated tranche. The strike price is set at the loss level of the subordinated tranche. So if the loss is even beyond that, then the put seller will compensate. Then the put seller will compensate for the difference, because the assets are being purchased at that particular price, which would be paid back to the senior debt tranche. So what we are seeing in all these forms of external credit enhancements is the senior debt tranche is quite comfortably protected against any kind of losses that can arise on the credit sensitive assets. So companies can very well get into either an internal credit enhancement mechanism or an external credit enhancement mechanism. As I have just mentioned, the two key forms of internal credit enhancement are the subordination and over collateralization. Whereas when we are looking at external credit enhancements, we can look out taking an insurance policy, getting for a letter of credit, or getting into a credit default swap, or going for put options on the assets. So these are the various ways in which the credit ratings can be improved, which can very well result in creating a better structure addressing the better needs of the various groups of investors. Now, the next important aspect that we need to look at here is, what is the liquidity risk? How do I assess the liquidity risk in these kind of structures? Whenever we talk about the liquidity risk, it is primarily looked at from the perspective of the cash flows from underlying assets, cash inflows from the assets are not sufficient to meet the cash outflows that are resulting towards the various liabilities. Means like various payments that need to be made on the securities that are issued at any point in time. So two broad ways to look at is, one, the timing part. So the cash inflows are coming, let's say, every 6 months, but the cash outflows are happening every 3 months. So just as a simple example, the first cash inflow will come only after 6 months, whereas I have to make my first payment after 3 months. I may not have any kind of cash with me to make that kind of a payment. That is one kind of a problem that can get into the liquidity risk. Or the losses or the defaults on this are higher than expected kind of a defaults if they are there, right? Then the cash that is there may not be sufficient to fulfill all the interest and the principal repayment that may have to happen towards the various securities that got issued. Again, here also we will talk about the internal enhancement mechanism to address the liquidity risk as well as the external ones. When I look at the internal, there are two major mechanisms. One is you structure the maturities in such a way that you see the timing of the cash inflows from your assets, and you design the liability instruments in such a way that the cash inflows of the assets are matching with the cash outflows. Probably it is more and more it is more and more theoretically fine, but in reality what could happen is, even if there is no default, if there is a late payment happening on, if there is a small late receiving that is happening on your asset, probably you may have to delay the payment on your liabilities also. So though there is no default, there is a delay in terms of the payment process. So that is where what we can very well say is, here when we are issuing these securities itself, they can be issued with a kind of extendable note. What is this extendable note? I will provide both an intermediate maturity date as well as a final maturity date. By this time, if the cash flows are sufficient enough, the bond is getting redeemed at this date itself. But if the cash flows are somewhere insufficient, it can go up to this date and get redeemed at this particular date. So in that way, while you are creating the original instrument itself, you are making sure that the security duration can very well be extended in case the cash flows are not sufficient to meet the liability requirements at our cash outflow requirements at any point in time. Then there could be another mechanism of creating a liquidity reserves, which is more similar to creation of a cash collateral account to address your credit risk. You can create the liquidity reserve. Again, here also the liquidity reserve also could be created by the originator itself, primarily to smoothen the liquidity problems, right? And again, this reserve, you can create this reserve either at the beginning itself, or from whatever the excess spread that is getting generated during the process. What do we mean by this excess spread? We are talking about the return on the assets, right? Return on the assets higher than whatever is the cost on your liabilities, even plus your various expenses also. Whatever the excess that is coming up, using that excess spread also, we can create the liquidity reserves. Even that kind of a mechanism can very well be worked out. When I'm talking about the external mechanisms, again, just like the credit enhancements, even the liquidity enhancements could come in the form of line of credit, letter of credit with full recourse, or we can get into an asset swap. So asset swaps, basically it is like it's a swapping of a fixed payment, swapping of fixed per floating kind of a payment. Why? The whatever the returns that are getting paid on the that are getting obtained on this asset, they are swapped with the counterparty for a floating rate plus some kind of a spread. In a way, it is actually becoming a total return swap. So because of this total return swap, even if there is a kind of a fall in the asset value, even if there is a loss in the asset value, so because this party is paying the asset value here, a negative value has to be paid, which means this party only will compensate it, which is resulting that any losses that are coming up on the asset in this particular period, it is getting compensated by the swap seller, by the swap dealer. So logically it is becoming a total return swap, and it is protecting you against any kind of a liquidity risk. And the letter of credit, just like the way we have discussed earlier with respect to credit risk enhancement, it is also working out in terms of enhancing the liquidity risk. And what about the other risks that can come up? Let's say the interest rate risk. When I talk about the interest rate risk, in general, we see coming up because of the timing differences. The assets cash flow that is generated from the assets and the cash flow that has to be paid towards the liabilities, the difference in the timings is creating an interest rate risk. And along with that, the primary structure, how much has to be paid to each of the various tranches. A difference in the payments to each of the tranches is also creating an interest rate risk in the process. Along with that, we can talk about a currency risk in the structure, wherever the currency mismatch between the assets and the liabilities. So my assets are in some X currency, whereas liabilities are in a Y currency, then obviously the exchange rate risk also does play an important role in terms of creating a liquidity risk. So a fluctuation in the exchange rate may make my assets more valuable compared to the liabilities, or vice versa. So even addressing those kind of risk concerns also are very much important as a part of the securitization structure. And what we typically see is these kind of securitization processes can happen, let's say with mortgage-backed securities. When I say mortgage-backed security, one of the most popular securitization vehicles, what we are seeing is the underlying pool is a set of mortgages. A set of mortgages, especially the residential, or even there could be commercial. So there could be a commercial mortgages, or there could be residential mortgages. So we talk about these kind of securitized instruments called as RMBS or CMBS, commercial mortgage backed securities. Similarly, we can talk about asset-backed securities, where the underlying assets could be your credit card receivables, or they could be student loans, right? They could be vehicle loans. So all these loans are being sold to a third party, which is an SPE, who will create instruments, who will create securities based on them and sell them to the investor community. So in this itself, we can talk about asset-backed commercial paper. So commercial paper itself is a very short-term instrument. Generally, this is issued where the underlying base is like a credit card receivables, very short-term receivables on a credit card. So using the credit card receivables as the underlying asset pool, the SPE will issue an asset-backed commercial paper. But of course, in this kind, all these wherever you find a mismatch between the cash inflows and cash outflows cash inflows from your assets versus cash outflows to your liabilities, it creates a significant liquidity risk. So all these things have to be addressed quite comfortably before getting into any kind of securitization processes. All right. So this is in a quick nutshell understanding the securitization process. If you have any further queries on this, you can get back to me by giving me a call on the number that I have provided below, or you can send an email at vamsidhar@pacegurus.com. Thanks a lot for listening to this session. Thank you very much.